All right, everybody, how's everything? We're going into further segments into RSI now. Now that we're into a new segment, what you'll notice though is that all the past segments will be included, right? So we're always going to have a situation where I may have, actually, I will have additional lessons that are really primarily focused on moving averages and stochastics as well. But instead of them backtracking them into a previous section where it gets confusing, we can just basically roll that into the RSI section in any future segments that you do have. And the idea for that is that you really want to make sure that you encompass everything that you get and learn it all fully. I mean, just to give you an example, I might have given this example before, but something like a calculus course, right? Calculus, mathematics, it's something that's really nothing more than an extension of Algebra 2. Just much more drawn out with literally a couple different terms, and the rest of it is encompassing all of the algebra that you had learned up to that point. So, with that said, if you don't know everything from Algebra 1, Algebra 2, of course, it depends on where you learned it and how they teach it. But the point is, if you don't know all of algebra prior to that, you're going to have some trouble, right? You're going to have some real issues. And it's sort of the same thing here is that you can continue to move on, but if you're forcing yourself to move on, even though there's some elements that aren't clear, now, it doesn't mean it has to be crystal clear. No, maybe crystal clear takes, practice. But understanding the concept is key, right? So if I give you some concepts and you can come in and identify it, but maybe you're not able to do it in real time, but at least when you go back, you can say, well, wait a second, X, Y, and Z, and that's why this is it because of the rule that I received. And yes, I should have known that. So if you can do it in that manner, then so be it. You might be able to move on, but you also have to judge for yourself, and only you know yourself more than anyone, and awareness is key. So if your awareness tells you, hey, you know what, I need to slow things down here, then by all means you do. You need to slow things down and kind of go back a little bit. With that said, today what we're going to focus on here is we're going to focus on divergence, right? Now, this will apply for divergence on just about anything, but I'm going to speak specifically on RSI divergence. We've spoken about divergence before, but now that we're going deeper and your knowledge is a little bit greater, I want to go ahead and dive back into it a little bit because you might recall, and I'll repeat it all, of course, that, in my opinion, divergence alone is very unreliable, especially at smaller scales, right? When you're talking about something like a 15-minute, 30-minute, 1 hour, it can be helpful for a small trade, but it certainly is unreliable. I mean, if you're trying to trade off divergence alone, you're going to have a real hard time. The other aspect is that we see that people do divergence, and usually your divergence is going to be based on your indicator, right? And the majority of the indicators we're utilizing fall into a range of 14, and usually hover around that level. But people will look at something and they'll say, well, look, there's a divergence between this period and this period. While that is true, but on this 2-hour scale, you wouldn't take a divergence from here to here, right? So I'm assuming that you understand divergence and the divergence cheat sheet. I'm not going to go into that today. That's something that you can Google right now and have it on the side of your screen, divergence cheat sheet, just in case you haven't understood or learned how the actual divergence work with an oscillator, because that's pretty basic and takes 5 seconds to type. But what we're going to focus on specifically are some basic rules, right? Now, one of those basic rules is that even though it's 14 periods, to me, the divergence that I pay attention to are going to be tight divergence. Okay? A very tight divergence. And the things you're seeing up right now, and I don't even know how accurate they are. It's not the purpose. I'd rather this be quicker than anything else. But what you're looking at, just so that you have an understanding, is you're seeing R for regular divergence. It's only RSI that's up here right now. And all of these are some form of RSI divergence. And like you've heard me say in the past, in my opinion, you want to absolutely learn how to do this on your own. You don't want to rely on an indicator. If you rely on the indicators make mistakes. I promise you, they make all kinds of errors with their divergence. So you want to be very careful with that. But it doesn't change the fact that I want them to be nice and tight. So I actually have a couple versions up here, right? So one is when you're seeing yellow, you're seeing a yellow regular bear divergence Y because it's on the top. You're seeing a yellow H, that's a hidden bull divergence Y because it's on the bottom. But you're also seeing some red and green ones. And these red and green ones, they represent tight divergence. So if you want to write this down, I prefer my divergence to fall inside of 2 to 5 candles or periods, right? depends if maybe you use bar charts, but most of us use candlesticks. So I want it to fall within 2 to 5 candlesticks. And you might ask, well, so what does that mean? Well, basically, instead of a situation where if I see this and this as a divergence, what do I do then? If I'm telling you, no, don't utilize that as your divergence, then you're going to want to what? Raise the timeline, right? Your time frame to get those two particular levels tighter. So although you are identifying divergence, right? And it appears that that was accurate, I still want to minimize it so that I can get inside of 5, right? And then if I can get inside of 5 between those two bigger pieces, I might be able to see if there's a divergence that exists, right? Well, in this situation, the two levels that I was speaking about, right, which were very separate, there was not a divergence on that scale, right? On the proper scaling. Now, that doesn't mean divergence didn't exist, because we could see right here that there was absolutely a divergence on a lower time frame. It's just not the two comparisons that I was utilizing before, meaning not this point and that point. There is a very tight divergence here, as we can see, between here and here. See that level? And this falls both on RSI and stochastic for this particular example. Now, just to verify real quick so you can see it for yourself, 1, and I'm not going to do this every time, I'll do it this one time, right? But it's 1, and here's the height of the RSI, and then you end up with what? A second, third, fourth, fifth. So 5 periods later, I have higher price on a closing level, raising price, right? And a lowering RSI. Now the same divergence appears on a 2-hour scale, which I'll show you here. Give me 1 minute. Okay. So I was even able to raise it in this case, right? And make it even tighter, right? And the tighter they are, believe it or not, the more they spook me out. I pay much more attention to, something that's, well, like I said, if it's not 2 to 5, I'll raise it. I'm going to explain to you why in a second. Because what you don't want to end up doing, and I'll show you. I mean, since we have this example here, forgive me, I can't find my pointer. And there it is. So since we have this example right here, right? This is a very tight divergence, but you always hear me speak about time frames and the importance of understanding time frames, and this is kind of the reason why. Because if you tried to take this same trade on 12-hour, you would miss the trade, right? Because ultimately, your thought of this is divergence, right, would not have been confirmed, right, until the low of this candle was taken out. Or you would have called that divergence for here, right, in this case. Well, let me see, maybe. No, actually, forgive me. I'm looking at something wrong. Okay, it's this one right here. So here, you would have said, all right, so RSI went up, price went down. I got you. But either way, the point is, when you do it at scale like that, it's the same type of scenario, and I'm going to explain what I'm referencing here, so forgive me for that little mix-up here. But the idea is that when you do that at times, you'll end up putting yourself in a position where you're comparing two periods. This is a better one, right? So in this example, you could be comparing these two periods here, and you could say, well, wait a second, look how high RSI was, and then look at how price went higher, which it did, right? But ultimately, you'd be in a position to where you're calling this divergence. And in this case, it might have still worked out. But the reality is that wasn't the divergence. Divergence was from here to here, it looks like, right? So you had some divergence in this case, or at least until this one right here. So that might have been that divergence playing out there, or another couple in the inside. And really, this one might have just been by chance that it worked out, because it's a separate divergence that's now occurring, right? It's really this one to this one. So if you didn't have this lucky formation here, you could put yourself in a position where you're comparing a long divergence and creating a scenario where it doesn't work out for you, or you miss the trade. Okay, if it's nice and tight, you're going to find much better success in utilizing it. Now again, does this mean that we utilize every tight divergence and use that as a trade? No, in fact, this is very important too. So that first rule that I told you to write down is that we're only going to care about divergences that we can find inside of 1 to 5 candles. What does that mean? That means that I have my initial candle, right? Technically, I guess you can call it 6, right? Because if I have 1, I prefer 5, but let's even give it the benefit of the doubt and say 6. But I'm going to call, if I had 1 here and the next one was a divergence, I would call that a 2-period divergence, right? So I'll give you 6. So let's say inside of 6 bars, but that would be counting the first bar, 1, 2, 3, 4, 5, 6. If I didn't have a divergence from there to there, I would raise my time frame by one level, right? A 1 hour would go to a 2 hour. A 2 would go to a 4, as an example. A 4 would go to an 8. If you were, if you were at a 2 and 4 didn't have it, if you wanted to look at 6, feel free, right? So you can scale it that way as well. But you want to try to bring it as far as possible to find out where that divergence is, because sometimes what will happen is you'll create a scenario where you go to a daily now, and you might have seen that divergence appearing or looking like it's appearing, but really on the daily it wasn't there. So that can create a couple benefits for you to know that, look, maybe there is a divergence on H1, and that will play out to be a nice trade, but it's not at the proper scale that's going to give me some full-on reversal, as an example, right? So trust me on that one. The stronger ones are going to be inside of 6 periods, okay? And the only reason I'm calling it 6 is because I'm going to call the same candle as 1 as opposed to the other route. So some people might look at this as 1, 2, 3, 4, 5. I'm saying go ahead and count that first one where the divergence starts and go 1, 2, 3, 4, 5, 6. Okay, so hopefully that wasn't too much of an issue. Now the second thing I want you to write down is this. Divergence alone is never the reason for a trade. It just can't be, right? It can't be divergence alone. Can it be your main reason? Yes, sometimes, but it's going to be rare, right? But it can't be the reason, okay? Because you're going to have trouble. Why do I say that? Let's go ahead and now bring up something like a 15-minute chart. All right, well, obviously I'm going to a low time frame to achieve this, and it does pretty well, especially these tight ones. So just so you know, I don't know if I clarified it earlier, the red ones are the tight divergence. The green ones are tight divergence going to the upside, okay? So on the red ones, look, they do well, right? But usually for like 1 to 3 periods is what we can trust the divergence for. Can sometimes it go much further than that? Absolutely. But 1 to 3 means it might just be one candle. And then sometimes they don't play out at all, right? Because nothing in trading is binary. So with that in mind, yes, we can see that there are some. But when I explain the next rule, you'll kind of understand why you don't want to take that alone as a reason for a trade. You want to have some confluence or some other reasons why you're entering a trade, okay? So now you've written that down. Pause it if you need to write it down again. I'll repeat it one more time. We don't utilize divergence as the sole purpose for the trade. There has to be confluencing reasons, right? Now, maybe that confluencing reason is, hey, I got divergence and stochastic falling in the bear control zone under 50, or bear crossing in the bear control zone, or bear crossing from the bull, now falling into the bear. A lot of different reasons, right? That I got my stochastic, I have my reversal showing my we have my tight divergence showing, yet I have a RSI that now is falling and below my green and red. Okay, that's a couple reasons at least. If you can have even more, great, and we'll discuss that in a minute. So those are a couple elements. And then the next thing that I'll explain to you is this. Let me go ahead and change my chart again. Okay. So you see all these divergences, right? So would they have treated you so bad? No, not so terrible. Again, green are tight divergences that are bull divergence. Red are tight divergences that are bear divergence. Then I have the regular yellow R's, and then I have the regular yellow H's. If they're on the top side, they're bearish. If they're on the bottom side, they're bullish. Okay. With the H's, some of these are tight, which is fine. I don't have those separated. And I always want you to pay attention to a hidden divergence. And of course, if it's tight, again, same thing. I'm more interested in seeing a tight divergence on my hiddens as well. So there's no difference there at all. So I pointed out why you don't want to utilize that as the main reason for a trade. And now we get into the main element here of how do we use them, right? Because that should be the question. So what do I do? Now you're asking the right question. Okay. Well, here's the thing. First and foremost, part of it is really a little bit of market psychology, right? A little bit of trading psychology, in that we want to put ourselves in a position to where we're identifying everything that's going on, right? So we always talk about this. Start right here, always, right? You start right where you're at, you look back to the left. So, of course, setting some things up like, hey, supports, right? Okay. Really quickly, you don't have to do some crazy drawn out element. That's just a very obvious support. You can go to the local ones, high and low, etc. But what do we know about this pattern more than anything? We know that we have been, in this case, obviously it depends on when you're watching this video, but if you looked at this particular pattern, you know that this is a pattern that is what? Consolidating, coiling, right? What it is exactly doesn't matter so much, meaning is it a symmetrical triangle? Is it a descending triangle? Whatever it is, it's a consolidation, right? And we can sort of draw that out and have a basic understanding. So this one seems to fit well, makes the most sense, but what we know is the pattern's consolidating, right? It's not trending. There's some element of range going on, okay? So now that happens, it really depends on where I'm at. Well, right here, just to utilize this example, I'm here now. Well, I'm going to go back and look at some past examples as well. But what I'm here now, I'm going to say, all right, well, what's coming up next? So if I'm going to look towards the top side, well, first of all, I want to go ahead and focus on the levels that are closest, right? So we go to the previous element of the structure, and I look here and I say, okay, well, this here apparently appears to be some element of a support, right? So you can mark that off. This is going back old school to anatomy of a trade type stuff. There's actually several in here. So if you drew it something like that, I completely understand. That would just be a bigger version. There's nothing wrong with that at all. Does that mean that it's going to hold price? No, not at all. It's just something for you to consider. And when you see that, you say, all right, well, am I above or below it? I'm above it. Okay, so same thing. I want to go ahead and mark a few of these areas off. And the way I would do it, and I'm going to show you guys, right, is I take one. I'm going to be on a daily scale first. So the first thing I do is I take a daily scale, even if I'm trading intraday. And I'm going to draw this line from the top of the wick. I'm going to do several lines here. You're going to say, what are you doing? And you'll see why. Because we're talking specifically about divergence and how I would utilize it as part of a strategy, right? There we go. So the first thing I'm going to do is I'm going to go top to the top, right? The two top points that I have, and that's going to be one of my lines. The second thing I'm going to do is I'm going to go the highest close to the highest close in the formation. So now I got two lines up here. And then the next thing I'll do is basically a hybrid of both, where I go from the top to the highest close. Just like this, just in case. Now, as an example of this, let's just say I ran through here, which was the highest close, but then I seen I had a price above that. Well, if it was a closing price, that would make this the highest close, and I would have to bring it up, right? But that's not the case here. The highest close is right there. One thing you can do if you have trouble with this, you guys can certainly put this on a line chart like that. And now you'll see I'm touching the line. If I want it to be even cleaner, I can touch the top of that line right there, just like that. You can also use a ray if you want to shoot the ray out. They're a little bit more accurate at times. So this one's pretty good. Then I'm going to bring my candlesticks back. And now I have a few different periods. Now, which one's right? Well, that's the thing. I don't know. See, I don't know which one is right, and that's why I draw them all. Because if I'm in a trade, or if I'm looking for a trade, well, then I want to see how price is going to react at these levels. Is it this level? Is it this one? Is it that one? Maybe it has to do a dance where it plays with this one, rejects, gets to the next one, gets to the next one. I don't know that, right? We don't know. We're building a story here, right? And we're going to let them tell us the story. Okay, so in this example, here we go, but you say, well, how am I going to use divergence for this? Aha, now you're asking the right questions again. Well, let's go ahead. First of all, let's bring this down. Let's see if it gave us this drawing on the other ones. Of course, it did not. Oh, yeah, it did. Okay, good. So perfect. It gave me the drawings that I wanted. So I can, first off, look at multiple time frames. Now, look, guys, you don't have to look at things in multiple time frames at all times. I know it can be confusing, right? That's fine. But you do want to peek at them because it gets difficult. Why does it get difficult? And I'll go down to 2 time frames just as an example. But you can scan a little bit this way, which is helpful. It doesn't have to be the 1 and the 2. It could be a 4 and a 1, a 2 and a 4. But you do want to scan a few of them just to kind of peek in. And you do want to literally look yourself at possible divergences. Remember, that's the whole point of this. We're talking about divergence plays, right? And what you'll notice is that when you get into these areas, you have to have a mental idea in your head of this, which is, let me explain this to you because some of you guys may know this perfectly, others just don't understand it. They'll see a 4-hour candle close above this level, and in their mind they think, oh, this level's not the one. Look, a 4-hour level, a 4-hour candle just closed above. So we must be going higher. No, no, no. Now you can play it that way. You absolutely can. But you better do it with the framework, the frame of mind that says, you know what? I could be jumping the gun here. Because what really matters, pay attention, I'm going to box this for you, okay? What really matters is the daily close, okay? And that daily close can easily end up looking like a regular old wick, which would give this particular line some credence, right? So we're mixing a few things here. We're not only talking about RSI divergence, we're talking about structure. We're doing a little geometry, which just means drawing lines, right? And just trying to see if we have another type of possible support or resistance area to pay attention to. And at the moment, in this example, it looks like we might, right? We had a little resistance area that you saw how I drew these, right? I didn't utilize any of this candle. I was using past candles, and we had a little rejection there a couple of days back. And so far on this day, a rejection as well on this particular line. So on the daily scale, you certainly want to respect that, but let's go back to the 4-hour, because if you're in real time, first of all, you were thinking, hey, this might look okay. But here is the key, okay? How do we identify a local top or a local bottom? Okay, we've spoken about this before, but let's clarify it. Okay, so now you have some candles that are moving on up, and basically it means you're making a swing high, which means what? You get a series of candles where you have some candles on the left, some candles on the right, and you have a candle that makes a high, closes above the previous high, right? And then you have some candles that pull back, and then another run up. And every time you make that high, I know this seems probably very basic, but every time you make that high, that is a swing high. Every time you make that high, you're also creating, now I'm going to take this box out for a second, you're also creating a local high, right? What would be the local high candle? Well, the local high candle is going to be one where you take out, more likely usually take out the low of a previous candle. You'll notice it doesn't happen too often, right? It happened here. It was kind of a fake out, but then it also, right there. So you could have said, all right, well, that's my local high, right? You might have thought it would be, but it ended up bouncing back, so that's fine. Then again, same type of thing. But local highs can be very easily taken out, and you get a new high, another local high, right? Which ends up being not this, this is a big candle, so sometimes it makes it very difficult for you, right? But right there, you had that little candle, the low gets taken out. All right, it just means, we're pulling back some, and then you're going to have to pay attention to the structure to see if the structure continues. Higher high again. Okay, we're looking for a local. This one technically gets taken out right there. That's your local high. If I move this box just so you see it again. Why? Because this particular candle's low right there does get taken out, drifts lower a little bit, but then goes one more time. And then finally, in this setup, we get something very unique. Now, I'll come back to this in a minute, but now here, 4-hour candle. And this is basically like a doji, right? Or an indecision candle. If you want to bring up, a candlestick cheat sheet, maybe I can bring one up for you just to have it here. Of course, you guys can bring these things up. They're pretty basic, right? You don't need to know so much about candlesticks. You just want to know, what kind of pattern is it? Is it bullish, bearish, or indecisive more than anything, right? So here you are, bullish, bearish, indecisive. What are we talking about? We're talking about this right here, neutral. See these neutral or basic patterns? So doji, right? Basically anything that has a shadow on both ends, right? Shadow, shadow, spinning tops, right? Now this is a pair of spinning tops, but any one of these spinning tops would be a neutral pattern. Now this, don't be confused, it's showing a combination, right? And by the way, I wouldn't view this as so neutral, only on low time frames. On a higher time frame, that would be close enough to a bearish engulfing to scare the life out of me, right? But the point is that mainly these guys, right, when you have long shadows on each side, then you can view those as neutral patterns. They're not, some people see them as straight bearish. They're not straight bearish, right? Here's another one right here, right? So you got, doesn't matter what the body is it green, is it red? You have a shadow on both sides, no real decision either way, okay? And you can have indecision patterns that have, let me see if they put them up in here. Even if the body was full on the bottom side, but you had a long wick to the upside, same type of thing. I might see that as an indecision candle. So those are the basic ones. You don't have to worry too much. So you did get a little bit of one here, but it was followed up then by a doji. So this one had a little bit of concern, right? But then it was followed up by a doji, right? Or even a spinning top if you want to call it. I don't really care too much. But now this is our focus, guys. Because what you should be thinking here is, now I have the possibility of what? A trend line. And it's not just any trend line, right? It's a trend line, even though this is one we drew. Now, you can look back in history and understand that, hey, this happened before. This trend line was taken out a couple times, wicked through many times, and then held. Well, in this example, we're now above that trend line, but the daily is not. We have not closed, and a couple things happen here. First thing that happens is this. Doji. So I'm at an indecision. When I get a candle like that, I have to wonder, well, if it's an indecision candle, what are my risks? Well, the good news is this. If it went and made a new high, you can extend further up. But these are the candles you want to see because you've had a nice run up and then indecision is pretty clear. And then finally, guys, we're going to look at our divergence, okay? I should have put that candle like this, of course, right there, right? And now we're going to look finally for divergence in the pattern, right? And what shows up? Tight divergence. See the tight divergence? 1, 2, well, we'll count the first one. 1, 2, 3, 4 on the hourly. Let's look at the 2 hour again. 1, 2, 3. Very tight. Those are very tight divergence, right? Those are spooky. So a 2 hour, right? Given a tight divergence signal. They scare you. They should scare you a little bit. So how do we play it? First and foremost, we can look at that 4 hour again if we're doing it at that scale. We can also utilize, actually, let me do this first, okay? Same scale, doji, right? Excuse me, no doji. Indecision candle, but it doesn't even matter what the candle is. If you have that divergence on that candle, on the same scale, if you take out the low side of that candle, you definitely would close your long position. Now, does that mean it can't resolve itself right here and start back up? It can. But this would be a reason to close. Why? Why is that now the reason for a trade and not divergence alone? Because I have multiple factors, right? If I have divergence along with what? A local top, which is what that becomes when the low gets taken out, that could be the reason for me to exit my trade. Okay. In this case, I have 3 of them. I'm at a possible, it's still only possible, right? A possible trend line resistance area along with a local top of some sort along with very tight bear divergence. Okay? So that would be your exit. You want to make it as tight as possible. In this case, it's a 2 hour. But we could also look at that 4 hour scenario. We could say, look, I know I have bear divergence on the lower time frame. And actually, now that I look closer, let me look at this guy. I think the red, oh no, I thought the red was underneath. But, it's probably not going to show up on this scale. But let's see. Pretty close. I mean, it's still flat, as you can see. But either way, it doesn't matter. Let's just say it's the lower time frame. But even if it's only your lower time frame, I could still utilize my 4 hour if that's my trigger or that's the trigger I want to utilize or I want to give it more room. And the same scenario applies. It would just be, all right, if it's the local top, I want out, right? So in this case, the bottom of this candle gets taken out. You're gone, right? Same type of scenario. Now, you might be asking, well, is it a short? Yeah, it can be a short as well. Absolutely, that can be a short. Doesn't mean you should, doesn't mean you should have saw it. Nothing along those lines. I'm just speaking about some issues like, hey, exiting a trade, exiting it along, right? If you are long from here and you're trying to figure out a way to get out or why to get out, if you didn't take these, you like the sideways action that it contributed, maybe you like the higher time frame at that time as an example of what was going on in here. Maybe you're sleeping overnight for part of it. That's understandable. But at this point in time, it did give an exit signal. Okay. Now, look, sometimes I miss these exit signals. So if you happen to miss it, so be it. Maybe you weren't trading at the time. As I just mentioned, maybe you were sleeping. Maybe you were doing some other work. Maybe you were trading on a daily scale and you didn't happen to peek at it. That's okay. This happens to me a lot. I enter a trade here. The perfect exit was there, but I didn't get out till here. That's okay. We're just talking about ideal scenarios, perfect exits in a perfect world that you happen to be watching. If you're not, you're not. And this applies to any time frame because what's controlling the time frame is the divergence, right? We want that divergence tight, okay? Now, Going back though, I will repeat, can that be a short? Yes. And in this particular example, it was an amazing short. This happened to be a trade that was 15 minutes and dumped from there to there for the most part. At least 70% of that happened in a 15-minute time frame. Again, you would have had to been watching. You would have had to been on it. If you weren't, it doesn't matter. It's not about that. It's about learning. But what I do want to do is I want to take this back in time because you've seen that I drew that line, right? And we drew that line based on market structure. But I'm going to point out some things. Let's go back to, we can utilize the 1 hour, okay? Because these are times when you're seeing these pushing, right? Where things were threatening to move, right? And what did you get? Now, in this time, you didn't actually have a trend line just yet, so that's okay, right? We didn't know about it, but I do want to point out how well it will work to utilize some confluence. Because in reality, if you're looking for shorts, it's better to look for them in the top side of a range. If you're looking for longs, it's certainly better to look for them at the bottom side of a range. But the question will always be, well, how, right? How do I find it? So we saw the 2 hour made the most sense. We could start there. We can look at a 1 if we don't see a lot of good examples. But if we go ahead and look within this particular range, it doesn't matter what range you utilize, guys. You can do this on your own practice when we're done with this particular lesson, which will be soon, and see for yourself. But if you make a range, you'll see this a lot, right? Because we are ignoring a lot of these divergence, but what we're not ignoring it is at these key levels, right? So here we are, we come into a key level, and what do I see if I spread it out? Tight divergence, take my word for it. You can look later if you like, but you had a couple signals, right? Let's see if the 4 hour gave the same thing. I don't know. We want to bring them up even higher if we can. 4 hour, now it's getting pretty high for tight divergence. Maybe even gave us 1 or 2 6 hour. Maybe it gave us 1 6 hour. Maybe it gave us an 8 hour. I don't know. I'll go higher just to see if there was 1 8 hour mixed into those 4s. I don't see that. Okay, so that's okay. But you did get something as high as a 4 hour, right, on a divergence scale, which is significant, right? Over here, you see a 12 hour. I should have looked at the whole scale. Let me just do it for a minute. I'll go 12 hour. All right, so we know here we had 2 12 hour signals. This is very strong. And this one, I actually rather look at this one first, because I do remember this this particular time. So here you are, you got your drawing, right? Now, maybe at that time, as I mentioned, maybe it made sense that your drawing was like that you were wick to wick. You would have 3 of them up here anyway, so wick to wick would have been one of them, and you would have been in the situation where you're just past it, right? You're in that situation, you're past it, you're thinking, all right, where are we at? And you would have been above it before the close, but now you would have had 2 of these 12-hour tight divergences showing up. That is an exit signal, right? Is it also an entrance for a short? It was an entrance for a short. You did have this little tricky, say, hidden divergence there, so that could be problematic. So we'd have to look at some lower time frames as well. But again, I'm not one that says you have to go long to short, long to short, long to short. Would this be a short trade? It would be. It would be part of a short trade. Absolutely. You have confluence here, right? And then, of course, we're not even getting into the fact that you can get confluence from your lower time frame. You could say, hey, the 12 hours giving me a signal here, my 4 hours breaking down below, right, into the bear control zone on this right here. So maybe I go ahead and enter on that kind of signal when I re-bear cross. Maybe you catch it, maybe you don't. Maybe it was over here when you caught it. It doesn't really matter. Essentially, my point is that yes, that would absolutely be part of a strategy, right? Now let's look at these 4 hours. What do you notice here? Tight bull divergence. Tight bull divergence, right? Why do we care about them? Because they're near the lower end. They're near the lower end of our consolidation pattern, right? The lower side, and they're giving us bull divergences. So those are ones that we're intrigued by. That's the ones we're intrigued by. Not the ones that are mixed up, all over the place. We do care about that, right? You know my feelings for like hidden divergence in a bull trend. But what we're talking about here specifically is we're trying to give a little bit more credence, and the way we do that is, I'm not, if I saw a bull divergence, in a separate part of this process, maybe I might ignore it. But the fact that it's on the lower end, well, we know that, hey, this is some element of support, right? This isn't something that could have existed the whole way if we drew that support line from the beginning. So that's kind of the idea here. It's like, oh, okay, well, wait a second, some bullish divergence, even at a higher scale like this, great. If you go to a lower scale, we'll see some more pop up. Bull divergence, tight bull divergence, tight bull divergence, tight bull divergence, tight bull divergence. What about the bear divergence? Remember, we're only looking for the red. Okay, well, tight bear. You see where now here, look. These signals, not so great, but are they at the top of the range, guys? Now, by the way, when I zoom in, they're not the worst either, right? They always look bad when you zoom way out. So it's not that they're terrible. The tight divergence does decent, but as I mentioned, like 1 to 3 candles, right? So 1, 2, 3 candles. The problem with this is you wouldn't have confirmed it until you took out that low, so you would have been just part of a normal local high, got taken out, ran up again, part of a normal local high. But what makes it strong is, so all of these did fine, right? They did a couple dances, couple candles of a drop, which is fine. There was nothing wrong with what they did. But the reason why they didn't hold the same water as these other ones is there wasn't the confluence now of a possible trend line, a possible resistance, right? So, and I don't just mean any lateral resistance, meaning something, if we're obviously in a pattern here where we're being controlled, well, then we're going to be looking for elements that control us, right? So on the bottom side, we're only looking for longs. Doesn't mean that if you scooted on through to the downside and then came back and resisted, you wouldn't go short. You absolutely would. And as you reach these top sides, same scenario, you're going to look for possible shorts or at least exits, right? So if you were long here, you're looking for some exits here. And hopefully you guys take this in and understand what I'm trying to show you, because it certainly is valid, right? Even looking back in time, now we didn't know at that time. Well, we did. We actually did identify this as a resistance, but it's a little different resistance than what we're talking about. So I'm not going to include it. It certainly wasn't part of this particular drawing, right? Nor was this one, because we just didn't know about it just yet. So I'm not considering either of these, but I would tell you that if you look at them very closely, right, you end up finding this one a tight divergence, this one just a regular divergence. But I bet if I change the scale a little bit, I'll find myself a tight divergence up there as well. Because those tight, they sneak in, right? They sneak in at that last minute. Like there's one right there. There's one right there at the top. So, those are the ones that spook me. They don't always work, and that's okay. Nothing's binary, but they work enough to spook me out, right? So if I'm worried about hitting a high and I see a type of divergence, maybe I back off for a little while. Now maybe it's just going to pull back like some of these and just pull back a little bit and go again, but maybe it's a reason to take a little bit off the top, and then if I come back and get my hidden, maybe I jump back in, right? So if you get the hidden that follows, then that could be good. That's okay. Sometimes you see the hidden divergence follow, it will erase that signal, and that's fine. But this is something that I think will help you guys. You don't want to just say, oh, that's interesting, and move on. You do want to develop this so that you start to build that confluence in your planning to understand that, all right, with divergence, I want tight divergence for one. And then even still, I'm not going to look at every single one, because I'll go crazy having 5,000 divergences on my screen. But if they're inside of that 5 to 6 candles, right, and it's happening at a reasonable support and resistance, especially in a coil or something along those lines, well, then I'm going to see some confluence. I'm going to respect that signal, okay? And you might say, well, whoa, there was some over here. Exactly, and look how well it played out. 1, 2, 3, 4, 5, 6. So does it mean that it won't ever happen, that it shows up and then goes off on you? Hey, man, that will happen. If it happens, it happens. We're playing an edge, right? So I'm willing to play an edge. If it doesn't work out, I'll curse a little bit and be mad for 5 seconds, and that's it. It's over and gone. It happens, right? The reality is the edge is going to give you that benefit over 1,000 trades. So over 1,000 trades, utilizing your edge is going to make sure that you're doing far better. Okay, so that is it. That's it for this particular one. Hold on to that. If you didn't take it all in, watch it again, right? This video is not too long. Take a couple more notes again now that you've seen it once. Maybe watch it back a second time. Give me some feedback as well if you have any questions in relation to it. That's it. I'm out. We'll move on to the next video very soon.